Reyes, will you please call the roll?
Sure. Chair, Mayor's Office.
Brian Berge, representing Mayor Eric Adams.
New York City Controller's Office.
Allison Hirsch and John Dorsa, alternate John Dorsa, representing New York City Controller Brad Lander.
Public Advocate's Office.
Elizabeth Guzman for Public Advocate Jemani Williams.
Borough President, Manhattan.
Sutton James for Borough President Mark Levine.
Borough President, Brooklyn. Borough President, Bronx.
Martha Sabio for Bronx Borough President Vanessa L. Gibson.
Borough President, Queens.
Alan Swisher for Queensborough President Donovan Richards.
Borough President, Staten Island.
Dan Master, representing Staten Island Borough President Vito Fusella, disembodied but here.
International Brotherhood of Teamsters.
Ruben Torres and Julie Colby for Local 237 President Gregory Floyd.
Transport Workers Union.
Dave Katzman for TW Local 100 President Tony Utano.
DC 37.
Raymond Santander for Executive Director Henry Garrido, and we expect to be joined by Robin.
Okay, we have a quorum.
Right, I believe we have one item for the public agenda today before we proceed to executive agenda items. That item is the composition of the evaluation committee for the executive director for this past year. I believe on the basis of a discussion held at our last board meeting, the tentative hope to be confirmed today is that that committee would consist of Mr. Katzman, Mr. Swisher, and Ms. Guzman. If there is consensus on that point, may I have a motion to approve the composition of the Executive Director Evaluation Committee?
Motion to approve, Ruben Torres.
Second, Allison Hirsch.
Is there any discussion? Okay, all in favor of that motion, please say aye.
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 All, please say nay. Any abstentions? The motion carries, and my sincere thanks to all of the members of this important committee. I hope to participate on it in the future when I have sufficient information.
Great. So that completes
Brian,
our one.
just one point of information. The quarterly report that Steve Meyer and then Ed Berman will do is in public, not an executive.
Okay, well then we have a further item for the public agenda before we proceed to executive. And with that, I think we can turn the conduct of this meeting over to the Comptroller's office.
Great. Is Controller Lander on?
Allison, that was
Yes.
just that was R1, right, Elizabeth? Okay.
Yes. Sorry.
Is Brad on yet? Oh, Brad doesn't have the link. I just learned. Hold on one second. Let me get Brad the link. Apologies, everybody.
Allison, I just sent it to Steph.
Yeah, can you send it to Steph right now?
Yep, I just sent it over.
Okay. Who I sent it to?
Okay, the controller is joining now.
There he is. Okay. Brad, sorry to make you jump right in, but wanted to introduce everybody on the Zoom to Controller Brad Lander, for those of you who have not met him yet. And Brad, we're just got through a little bit of business, and then after you speak, we'll be going to Steve's quarterly report like we've been doing. So welcome, and I'll hand it over to you.
Thank you so much, Allison. Great to see everyone. Hope folks are having a good Monday morning after at least it was a beautiful weekend. Let's see, most of you guys I know and have seen before, but it is nice to be back with you again. Obviously, as Steve's going to talk about in a minute after we introduce him, these are really challenging times in the markets, and making sure that we meet and rise to our responsibilities of doing all we can to guarantee the best possible returns, but also just keep that long-term view. And remember, what we have here is really a duty to invest for the long term. That our funds are well funded, and that current retirees are in solid place, and that we've got a great team in place to make the kind of long-term investments that help us weather storms like this is clear. And so I'm delighted that we have a new chief investment officer to help. I also want to say thanks to all of you for our partnership last week on a really dynamite responsible investing win. As many of you guys saw, we stepped up together very quickly, our systems, and joined Amalgamated Bank and the Attorney General in a great campaign to push that our investments in MasterCard, American Express, and Visa were a vehicle for helping us make sure that they manage risks that they have been facing by not doing enough to make it possible for suspicious activities to be flagged around gun and ammunition purchases. And that thanks to the shareholder resolutions that we filed at MasterCard and American Express, from what we've heard from advocates, those played a significant role in helping make sure that what's called a merchant category code for standalone gun and ammunition stores, something that already exists for bookstores and bike shops and nail salons and pretty much every kind of business, will now exist for gun and ammunition stores as well. We believe that has the potential to save lives and to help manage the risks and liabilities that our investee companies are facing. So a real sort of win-win when we think about what responsible investing looks like. So I want to thank our corporate governance team for being in such a strong leadership position. It's not only that they stepped up to lead the way, but that the work that our systems do is really recognized by people as leadership, as somebody, a set of groups that will take it seriously, whose credibility is good, and who can move quickly. And that's not easy for anyone to do, but it's sure not easy to do across a system with so many trustees. And the fact that we're still able to do it together, I think is a real credit to everybody who's kind of built and helps to lead this system. So thanks to all of you for doing that. And then I'll just say, before I hand it over to Stephen, obviously our job here as trustees of these pension funds is to make sure that worker retiree benefits are there when they need them. But this is an important moment just to be reflecting on the role of the public sector workforce more broadly, which obviously, the current members are facing a lot of challenges as well. And then I think this is a moment for us as we think about how do we come through this economy, how do we build the next New York City economy coming through and out of the pandemic that is thriving, that's a place where people want to be, that we know a big part of that is our city getting the basics right. And getting the basics right, that's what our public sector workforce does, right? That's keeping our roads in good repair. That's making sure that the garbage is picked up, that basic public services from our schools to our parks, to our streets, to our transit is just one key critical element of providing a safe, sound, vibrant, diverse city. And I know as we think about how do we do that, how do we make sure we invest in the workforce in a way that helps us keep and maintain a strong city, that a big part of that is ensuring the retirement security that is our collective job here, in addition to the other pieces as well. So just like we're fulfilling a kind of a financial and moral obligation to our retirees, we are also helping invest in the city workforce that keeps this the thriving, diverse, inclusive city that not only we love, but that is the key to a thriving future economy that keeps things growing, that keeps tax revenue coming, that keeps jobs being created. That virtuous circle is a big part of what our obligations are in good times and in more challenging times like the ones we're facing. So we brought all of that sort of spirit and the commitments that everybody has here in this meeting to the Chief Investment Officer search. Took us a little while, but it's the first time that trustees have been involved, that we had an outside independent advisory committee of investment professionals to help advise. We had great candidates, and we feel really thrilled with the new Chief Investment Officer that search has brought us. And so it's now my pleasure to formally introduce you. I know a lot of you have met him already, and hand it over for the quarterly report to our Chief Investment Officer, Steve Meyer.
Great. Thank you so much, Brett, for that wonderful introduction. And good morning, everyone. It's a real privilege and honor to be here with you today. Hopefully this is the first of many such presentations, and I'm hoping to meet everyone in person. I know I've had the privilege of meeting some of you, but as we work through COVID and reduce the COVID protocols, hoping to meet you all shortly. Of course, I'm going to continue to provide economic and market updates designed to put some context around your investments, but always touching on 4 consistent themes. And those themes are investing for long-term outcomes, diversifying your investments, looking at the world through a global lens, and finally, investing consistently over long periods of time. Thanks, Kate. Slide 3. There we go. Regarding investing for long-term outcomes, this is actually the headline of a Wall Street Journal article back from 2020 that really caught my eye, and I think it does a great job reminding us that these pension promises have long tails. And this one was actually 155 years. Irene Triplett, mentioned here, was actually the mentally disabled daughter of a Civil War veteran. Her father was 83 years old when she was born. Her mother was 50 years younger than her father. And Irene lived until the ripe old age of 90. Again, so those are important obligations that have incredibly long tails and really give us the flexibility and the requirement to think longer term about our investments and the payment horizon. The next slide, this is actually one of my very favorite charts. This is the Callan's periodic table of investment returns. I know we have the benefit of a few folks from Callan on the line today. I've been looking at these charts for decades now, and always find them incredibly insightful. I think this does a great job demonstrating the variability of individual asset class returns over time. It also drives home the need for diversifying holdings across assets and strategies consistently. Next slide. Your plan's investment portfolio contains global assets, both U.S. and international securities, both in the public and private space. Our domestic economy and markets are impacted by occurrences beyond our national borders. First and foremost, I'd say would be pandemics. Probably more positively, though, are technological innovations, monetary policies of international central banks that impact currency valuations, trade balances, and country competitiveness. Geopolitical developments such as elections and wars and trade pacts and defense alliances. Climate change preparedness and initiatives, as well as demand for raw materials. It's important to remember that the U.S. is not an island, but an integrated part of a global society and economy. The next slide actually depicts several periods where the traditional 60-40 investment portfolio split really went sideways. Typically, this slide is titled "The Lost Decades," rather. Most noteworthy, 1966 to 1982, that 16-year period where the Dow Jones Industrial Average ended up below where it had actually started out. But I also think it shows the benefits of being a consistent investor over long periods of time to take advantages of that long-term trend, that move up to the right in terms of wealth creation over a long period of time, this period being 120 years. And being able to take advantage of those long-term trends such as innovation, growth in the U.S. and global economies, globalization trends, labor force productivity growth, and lastly, increased standards of living around the world. Next slide, please, Kate. Moving on to the economic and market update. Inflation is top of mind these days, both here and abroad. Inflation levels are actually nearing 40-year highs, both in the States and abroad. Our economy is emerging from, excuse me, a global pandemic and undergoing major transitions, which are also called post-pandemic headwinds. And here we name a few: an increase in demand for goods, services, and experiences, while supply still lags, pushing prices higher. A shifting monetary policy regime from very loose to much tighter, with higher official interest rates and quantitative tightening, meaning balance sheet runoff here and abroad. Continued supply chain bottlenecks, and here we're really talking about China and their zero tolerance COVID policy that results in city lockdowns that again hurts their commercial activities. And finally, labor shortages pushing wages higher. Those are related to COVID. More recently this year, we've seen higher energy and commodity prices, in large part driven by the Russian invasion of the Ukraine, particularly in the energy sector. The next page, next slide. These inflation outcomes are well in excess of the Fed's, the ECB's, and the Bank of England's expressed 2% inflation targets. And again, you can see those are real spikes on each of the charts, reflecting June in the States, 6.8% CPI, July 9.1%, and in the UK, July 10.1%. So very, very high levels of inflation. The next slide is a recent University of Michigan survey indicating high inflation expectations over 5%. This is the highest it's been in 15 years. And the Fed's real concern is that the longer inflation remains elevated, the higher the risk they become embedded in expectations and place consistent upward pressure on wages and impact consumer behavior. I think there is some good news. So on the upper right-hand side, you can see that the expectations, again, out of the survey moved down slightly very recently. So perhaps that expectation is starting to wane. The next slide. As I mentioned, higher energy prices have been a major cause of this year's spike in inflation. Russia's invasion of Ukraine has exacerbated energy price pressures in Europe and abroad. And the current situation in Europe is particularly strained with the closure of the Nord Stream pipeline. This 10-year slide shows West Texas Intermediate crude oil per barrel and reflects the price pressures that we've seen here in the United States. I guess the good news is that we're currently pricing oil per barrel for WTI at around $82 or $83 a barrel, well down from the high of over $120 a barrel seen earlier this year. So some relief there, but still elevated levels of oil prices in the States. On the next slide, in July, U.S. unemployment actually hit a 50-year low at just 3.5%. It's moved slightly higher in August to 3.7% as more people joined our domestic labor force. And the participation rate now stands at 62.4% versus 63.4% pre-pandemic. But we're still down over 2 million workers from before the pandemic. So we have that shortage of workers in our labor force, which is creating significant upward pressure on wages as employers compete to hire, attract, and retain good workers. We also have some demographic shifts at work in terms of retirements and low birth rates and lower immigration trends, all of which were made worse by the pandemic and are contributing to our domestic labor shortages today. Next slide. This chart shows 30 years of the misery index, which is basically core CPI inflation, or CPI inflation rather, plus the unemployment rate. And you can see at the outset of the pandemic, it spiked, and that was due to the spike in unemployment associated with businesses shutting down. But more recently, you can see the second spike is driven more by almost entirely by inflation. Today's high misery index, again, is the result of elevated inflation and really shows the challenges that the economy is putting on the average citizen here in the United States. A couple of historical notes. The highest misery index was under Jimmy Carter back in 1980 at 19.72, and the lowest under President Dwight Eisenhower in 1953 at just 2.97. On the next slide, This chart shows the recent disruptions that the COVID pandemic placed on global GDP growth. The spikes lower in growth were pretty universal at the start of the pandemic, while recoveries have been more idiosyncratic depending upon monetary and fiscal policy responses within individual countries and regions, as well as COVID protocols. Look at China, which is the blue line that hovers above all the others, and really reflects that China had been a significant engine for global growth, generating 8 to 8.5% GDP gains on an annual basis up until the pandemic. You can see the spike down in the recovery, but given the current problems with China's lockdowns, it's pushing both down domestic GDP growth as well as growth around the world. And you can see that on the far right-hand side. The next slide. This chart provides details for the U.S. quarterly GDP growth over the previous 6 quarters. The last 2 quarters on the right-hand side the growth has been negative. And the rule of thumb, the 2 consecutive quarters of negative GDP growth defines a recession. Although this is not likely correct today, consumers and the labor markets are simply too strong, and the recession determination will ultimately be made by the National Bureau of Economic Research with a significant time lag. So even though we may feel like we're in a recession to many folks, probably technically not in one yet. Next slide. Shifting to U.S. monetary policy, let's review the Fed's dual mandate. This is actually language from legislation passed by Congress in 1977. And it reads that the Fed's mandate was to achieve maximum employment, stable prices, and moderate long-term interest rates. Note that it's considered a dual mandate instead of a tri-mandate by assuming that stable prices will promote moderate long-term interest rates. The Fed Chair Powell recently stated his resolve to decrease inflation to its 2% target, even if it results in higher unemployment, which it very likely will. At the August Jackson Hole Economic Symposium, Powell stated that fighting inflation will bring some pain to households and businesses, and it probably will. The next slide. Here, the top chart shows 30 years of official rate changes. And note that since 1983, over 39 years, the Fed has increased interest rates 86 times. 75 of those hikes have been less than 50 basis points, more along the lines of 25 basis points. And that reflects that this year's rate hikes, beginning in March with 25 basis points, but then moving to 50, plus 75, and then plus 75, is actually higher than usual. The last time the Fed actually raised interest rates 75 basis points was 1994. And the market today is pricing in another 75 basis points at the Fed meeting this Wednesday, followed by 50 basis points in November, and then a final 25 basis points in December. All this comes to pass, year-end rates will be 3.75 to 4%, a significant increase in a relatively short period of time. Note also that Fed Chair Powell has pledged to keep rates higher for longer and not repeating the mistakes of the 1970s by prematurely cutting rates to support growth. So the expectation is that they're going to get to a level anywhere between 4, 4.5, maybe even as high as 5%, and stay there for a while as inflation continues to hopefully average down. The next slide. Higher U.S. Official interest rates, quantitative tightening, and tightening of financial conditions generally are pushing the yield curve higher. This is creating a very difficult environment for long-term bonds and growth-oriented stocks, which we'll see in a few minutes. And the yield curve is currently inverted, meaning that there are higher rates at the short end of the curve and not typically paying the normal term premium for taking more risk by investing in a longer-term asset. Inversion of the 2s, 10s, U.S. Treasury spreads are now 45 basis points. I keep changing it on my charts because the rates are shifting pretty dramatically last week and again this morning. Note also the 10-year U.S. Treasury yields are up almost 200 basis points since the start of the year. A very significant move. On the next slide, this represents investment grade and high yield corporate bond spreads, which have moved higher as economic uncertainty and risk has increased. Credit spread widening increases yields and puts downward pressure on bond prices and index returns. We'll see that in our fixed income and high yield results. And as you can see from the chart, lower credit quality high yield bond spreads over similar maturity U.S. Treasuries are more volatile than investment grade spreads. That upper chart, that upper line rather, in red shows more volatility around those credit spreads. Right now in high yield, spreads are about 480 over Treasuries versus about 140 over for investment grade. On the next slide, this reflects that the bond market pain associated with tighter monetary policy is indeed global. Inflation pressures are causing central banks around the globe to increase official interest rates and tighten monetary conditions. They do this to slow growth and decrease aggregate demand for goods, services, products, commodities, and of course, labor. China, however, is the rare exception year to date. They've actually been cutting rates and cut rates as recently as August to combat the sluggish economic growth that they're seeing with its zero tolerance COVID policy and city lockdowns. And you can see that on the far right-hand side, that even though all the other bond markets, sovereign bond markets, have seen significant increases in yields on the far right, at the far bottom on the right-hand side, you can see that China's yields have actually come down 13 basis points at the time of the snapshot. The next slide. U.S. dollars have been incredibly strong this year, trading at 2- and 3-decade highs against several key trading partner currencies. And this is due to a few reasons. Firstly, higher interest rates here in the States, a stronger economy in the United States as well, the fact that our currency has a reserve currency status in a lot of US dollars. And finally, flight to quality buying associated with an increase in geopolitical risks as Russia invaded Ukraine, and there's been some saber rattling on the part of China in the Straits of Taiwan. The impact on the U.S. dollar strength are a few. Firstly, on a more negative basis, it lowers earnings for U.S. companies with operations abroad as incomes repatriated in U.S. dollars. This creates a little bit more of a headwind for large cap equity stocks, U.S. equities. It's also a little negative in that it lowers the competitiveness for U.S. goods sold abroad as they become expensive in local currencies. More positively, it provides a little bit of a tailwind for the Fed, and it lowers imported inflation as foreign goods are cheaper for U.S. consumers given the strength of the dollar. The next slide just shows, again, where we are at 20 and 30-year highs in the dollar against the euro, which is now trading slightly below parity with the dollar, against the pound sterling, which is trading today at 113 and change, and against the Japanese yen, which the US dollar now buys 144 yen. Next slide, moving on. Is low, it's time to go. So perhaps this increase in volatility and price disruption or correction provides a buying opportunity for investors. On the right-hand side, we see the MOVE index, which is the Merrill Lynch options volatility estimate. Again, that's based off of over-the-counter U.S. Treasury options pricing. This measures U.S. interest rates and bond price volatility. And as I said, it's also moved significantly higher. And these higher volatilities indicate more risk and more uncertainty in the marketplace. Next slide. For 20 years, equity index gains have dominated. And you can see that, I think we skipped the slide. One back, Kate. Yeah, there we go. Thank you. You can see that the returns on the left-hand side clustered between 0 and plus 10%. And the past 2 quarters of 2022 are both negative on the lower right-hand side below that 0 line. Experience S&P 500 first half performance since 1962, coming in at negative 20%. And note that the S&P 500 has been up 22 of the last 30 years, pardon me, down just 8 years with an average return of plus 10%. Again, unusual times. On the right-hand side, and perhaps more newsworthy, the Bloomberg Barclays Aggregate Index for 2022 is remarkably negative. You can see that on the far right-hand side. The U.S. Ag has produced its worst first half performance since 1976, coming in negative 10.3%. 10-year U.S. Treasuries actually had their worst first half performance since 1788. I'm assuming they used probably New York or Philadelphia proxies for Treasuries back then. The U.S. aggregate has been up 26 of the last 30 years. The best year was up 18%. The worst year was down 3%. And year to date, 2022, it's down fully 10%. So really challenging time for bonds. Next slide. This is a wonderful slide. It really shows the tale of two very different halves of fiscal year 2022. On the left, you can see the second half of calendar year 2021. In the middle, the first half of calendar year 2022, and they combined to be full fiscal year 2022. And you can see that the returns were actually pretty healthy in the first half of the fiscal year. And then the negative returns in the second half of the fiscal year 2022 were so negative that they overpowered the returns in the first half to drive performance down and across all asset classes, with one exception. And that dark gray bar is actually the U.S. oil prices, U.S. WTI of 43% at the time of this analysis for the fiscal year. Next slide. The first chart on this slide shows the relative outperformance of U.S. stocks to developed equities ex-U.S. and emerging market equities. The middle chart reflects the drawdown of all three equity indices for full fiscal year 2022. And on the far right-hand side, the third chart shows the bear market rally in equity prices we saw in July and early August, and the resumption of stock selling in late August, which has spilled over into September as well. Next slide. Moving on to performance. One more slide. Yep, there we go. As indicated earlier, public market assets and investments were under significant negative price pressures in 2022. As a result, performance across all public markets was negative for both the second quarter of 2022 and the full fiscal year 2022. And it's hard to miss the two solid columns of red clearly indicating this in the middle of the page. The 5-year cumulative returns, however, were all positive across public market asset types. And on the far right-hand side, those are the capital market assumed rates of returns put forward by consultants, but that's over a 10-year period. And again, it's a little bit of an unfair comparison to look at 5-year performance relative to 10-year expectations. So we'll continue to monitor that and keep up to date on progress. The next slide. As presented earlier, the second quarter of 2022 was very challenging for all public market investments. Again, pulling down full fiscal year 2022 performance. John Mersberg is going to talk in more detail about the equity performance for that period. From a fixed income standpoint, the returns were highly correlated with equity returns, and given the significant backup in yields, delivered very little short-term diversification benefits for investors. 5-year returns, however, were positive across all asset classes. You can see that on the far right. Next slide, please. Private investment performance for the full fiscal year 2022 was positive across all categories, and significantly so. Note, however, that the private equity, core and non-core real estate, and infrastructure assets are all priced with a lag, and reflected here are pricing as of March 31st of 2022. NYCERS pension plan performance for the full fiscal year 2022 was negative 8.4%, outperforming its policy target returns of negative 8.7%. And your pension assets also outperformed its policy target return benchmark by nearly 100 basis points, in the second quarter of 2022. And you can see that on the lower portion of the slide in the middle. Your plan also exceeded its policy target return benchmarks by 10 basis points over 5 years. And again, thinking longer term and focused on longer term outcomes is preferred. On the next slide, the second quarter actual performance results are reflected here. You can see that excess return of 97 basis points when taking account of rounding shows that 20% of that came from over and under weights to policy targets, and 77% came from investment manager selection and alpha generation on the part of our outside managers. The next slide. As I mentioned, John's going to review your equity market performance in more detail. From a fixed income performance perspective, relative to benchmarks, the performance was somewhat mixed. Regarding convertibles, our program became much more defensive. We reallocated investments to stronger managers recently, and we were in a position for a risk-off market, and that's why the performance in converts has been relatively strong. High yield was also positioned defensively by our investment managers, delivering above market performance relative to the benchmarks. And core fixed income was below the benchmark a bit. And as I mentioned, it's a very difficult investment environment for bonds. And finally, TIPS performance for the full fiscal year 2022 was flat. And a lot of folks will ask questions, well, you look at TIPS, well, aren't they in an inflation hedge? Inflation's high, why aren't they outperforming? But they're still bonds and they still have a duration exposure. And as yields backed up, those prices were also pushed down. On the next slide, as you can see, private market excess returns relative to established benchmarks were very strong across all asset classes for the full fiscal year 2022. Long-term outperformance was generally delivered in 5-year, 10-year, since inception timeframes as well. A little bit of noise with private equity in 10 years, and that has to do with some of the legacy holdings and programs that were put on earlier years ago. And the real estate sector continues to recover from the global financial crisis as well as the pandemic. On the next slide, in the second quarter, we funded 2 new mid-cap equity managers. To achieve this, we actually raised cash by selling short and intermediate term treasuries. You can see that on the on the left. And we also reallocated funds to large cap equities to maintain a market cap neutral position in our equity allocations. Next, our portfolio over and underweights relative to targets were all within prescribed rebalancing ranges. Our cash overweights, if you will, relative to a zero target, were necessary to meet tactical needs such as paying pension benefits and meeting private market capital calls. And note that an increase in asset price volatility may cause actual deviations to targets to drift higher over time. So the more volatility there is, the more potential deviations there are here as well. And lastly, the costs of rebalancing are always considered when assessing potential rebalancing actions. And with that, I'll ask if there are any questions on anything I've covered. I should have said this at the outset. There's no such thing as a bad question, although that you may get a bad answer, but I'll try my best. Anything that I haven't covered or questions you have, anything I did cover, please feel free to ask now, or I can turn it over to Ed to go through his risk management quarterly review.
Steve, this is Ray Santander from NYCERS, if I may ask a question.
Sure.
Thank you for that presentation. My question regards the lag in the private market. So is there any indication, coming attractions as to what happened in the fourth quarter?
Yeah, there are actually. So I got an update from Anash and our private equity positions. As of the 1st of September, Ray, we have about 70% of the marks coming in, and they're typically down between around 3.3%. So not nearly as negative as we saw in the public market space, but I think it's logical to assume that the private markets will move in some way similar to the public markets, and that there's been compression on multiples, and we're seeing that in the private space as well. Infrastructure is pretty flat. There seems to be, those assets have held up reasonably well. And in real estate, we think there's probably going to be, mid-single digit markdowns as well. And again, sorry, go ahead.
I'm sorry, Steve, but so quick question then. Is the fiscal year performance then the final number that awaits a fourth quarter private market final numbers?
We actually don't restate the numbers. We actually use them with a 3-month lag.
Okay. Thank you.
Ray, that's a good question, Ray, because it's not really consistent across pension plans. But our protocol has always been to just leave them and recognize that there's a delay in those marks and live with that over time.
Thank you, Steve.
Sure. Any other questions? Ed Berman, do you want to give us the risk management review, please?
Absolutely. Thank you, Steve. And thank you, everyone. Glad to meet you virtually. And excited to be here to deliver my first quarterly risk reviews. Hope I'll meet all of you in person in the nearest future. And for today, we took this as an occasion, an opportunity to refresh our presentation. You'll notice a new layout and also expanded risk views. But first of all, before we dive into the presentation, I just want to thank the risk team at BAM who worked very hard to pull together this analysis in fairly difficult times. And most of all, my thanks to Don Haas. You've met him many times before, and he's now on the line and ready to step in and correct any mistakes I can make. Can we have the first slide, please? Thank you. So the total risk for the portfolio at the end of the quarter was 12.4%, which is an increase of 0.7%. It's a number in the lower right corner of the table. It's highlighted in bold font. Just to remind the trustees, this number represents the expected return of the portfolio over the next 12 months, meaning that we project the gains or the losses of your portfolio should be within plus or minus 12.4% range. This number also means that there is an about 15% probability that the gains will be larger than 12.4, and unfortunately also about a 15% probability that losses may exceed minus 12.4%. But what does this number mean? What is the intuition behind this level? Is it a good number? Is it a bad number? Should we worry about it? Or should we take some comfort in this level of risk? Broadly speaking, the level of risk in a portfolio is determined by two main factors, which is the markets and the portfolio construction process. The main decision in the portfolio construction process is to establish a stock bond split. Historically, equities delivered the best returns, but also the highest level of risks. We capture the first step of the portfolio construction process by the market portfolio in the table you see on the screen, column 1 on the left. It's a simple 60-40 blend of the MSCI all countries, which is the broadest measure of the global equity markets, and Barclays US Ag, a broad measure of the domestic fixed income market. The next step in the portfolio construction process is to determine asset allocation within each category, where we establish the ranges for the US equities, emerging markets, core fixed income, and so on. These decisions are reflected in the strategic benchmark, where the market portfolio is further split into 12 components, as reflected at the bottom of the page. The exposures for the policy benchmarks are captured in column 2, in the middle of the table. And finally, the last step of the portfolio construction process is to fill out each bucket with managers. It also includes all technical, such as an ongoing portfolio rebalancing and impact of the cash flows. This final step is captured in column 3 of the table. So by applying this framework, we get a better insight into the risk levels in your portfolio. So let's start with the market portfolio in column 1, which is a simple 60-40 blend, and review its main portfolio attributes. Let's start focusing on the portfolio construction section on the left, on the top of the page on the left-hand side. There are 3 main dimensions of risk that we take in this portfolio: equity, interest rate, and credit. These risk dimensions are shown at the top of the table. You can think of these dimensions as a representation of the main market opportunities to generate the returns. More exposure to these dimensions means potentially higher returns, but also comes with a greater probability of losing money. Equity exposure is captured by equity allocation, first row of the table. It is obviously 60% by construction. This is by far the most important number in the portfolio construction process, which drives most of your risks and returns. The next dimension of risk is interest rate, which is the time value of money. The best way to measure the exposure to interest rates is through the duration of the portfolio. But what does duration mean? Simply put, it is just a helpful scaling factor that translates interest rate moves into the changes to the portfolio's market value. So exposure to rates come from the Barclays US Act component of the portfolio, and every single member of this index has sensitivity to interest rates. The magnitude of the interest rate exposure is shown in the next line. You can see that the rate's duration is equal to 2.6 years. It means that a 1% drop in interest rate translates into a 2.6% gain for the portfolio. The final dimension of risk is the credit spread. Only the bonds issued by private borrowers have exposure to credit risk or the risk of default. For this reason, only about 40% of the Barclays US Ag has exposure to credit component, since 60% of the index is made of the treasuries and agency securities. Much like the rates, the exposure to credit spread is measured by spread duration, which is just a multiplier to translate spread changes into portfolio market value. So the duration of 1.6 means that a 1% decline in credit spreads brings a 1.6% gain for the portfolio. Notice that the spread duration is lower than the rate duration because of material allocation to US treasuries in the market portfolio. So how does this portfolio construction translate into the risk measures? You can see it at the bottom of the table under portfolio risks. We present here 2 measures of risk, starting with the total risk measure, which stands at 11.1% at the end of Q2. It is basically just a range for the expected 12 months returns for the portfolio. Again, just to remind, there's a 15% probability that the returns will be higher than that, and all the losses will exceed minus 11.1%. You can notice that total risk for the market portfolio increases quarter quite significantly by almost 1%. This is a direct result of the volatility in the markets as we'll go through this historically extraordinary period. As a point of reference, the volatility this year in the equity markets is measured by the VIX index, around almost twice the pre-COVID level. The action was even more dramatic in the fixed income markets Steve just mentioned, where volatility ran at almost 3 times the pre-COVID level. As a matter of fact, last time we saw comparable levels of rate volatility was during the global financial crisis. So the total risk gives you a measure of the portfolio future expected performance over the next year or so. The other risk measure we show in the table is the beta to the S&P 500. It is a risk measure that has a shorter-term focus. It is an assessment of how the portfolio will move on average when the overall stock market increases or decreases. So the beta of the market portfolio shown in the bottom left corner of the table stands at 0.556, unchanged from the previous quarter. It is interesting to note that the beta is actually smaller than the equity allocation of 60%, meaning that your portfolio is less sensitive to the short-term equity moves than implied by the equity allocation. The reason for that is the allocation in the international markets to active managers, but most of it comes from the fixed income allocation. The decline of beta versus equity allocation is a result of a portfolio construction, and it's a desired outcome. So it's a positive. So now let's move to the market portfolio, from the market portfolio to the policy benchmark, which captures the asset allocation decisions. It's column 2. You can see that your portfolio is balanced towards a slightly higher equity allocation, 63.5%, which mechanically pulls the rates and credit exposure slightly lower. An additional drop in the rates duration versus market portfolio comes mostly from the allocation to high yield, which tends to be of a shorter maturity and therefore shorter duration. A small decline in the spread duration comes from a further allocation to TIPS, as they have no credit risk, being government bonds. Notice the duration of the policy benchmark is unchanged for the quarter, similar to the market portfolio. So how did this risk level of the policy benchmark compare to the market portfolio? It actually held up pretty well, as you can see at the bottom of column 2. The total risk level remains almost unchanged, small increase, despite a high allocation to equity, and the S&P beta ticked up slightly. Again, this is a positive, it's a good outcome. We expect superior returns from the asset allocation, not an increase of risk. This is exactly what the asset allocation process is meant to deliver. So finally, let's move towards the portfolio, which is shown on column 3. You can see that the portfolio is closely aligned with this benchmark, but let's go over small differences. There's a small change in the equity allocation, which is really not that material. It's within a typical rebalancing range, and we'll see more of it in the next page when we go over the details in the portfolio. During this quarter, the plan increased its allocation to private equity and private real estate, mostly funded from public equity, so some rotations within the allocations. You may also notice that the small duration overweight versus the strategic benchmark. While we managed to raise exposure to the public markets flat to the benchmark, the small duration overweight comes from the ETI program, which brings exposure to long-dated mortgages. The same program is also driving a small overweight in spread duration. So how does this all translate into the risk measures? You can see them at the bottom of the table on the right. Again, the risk measures are broadly in line with the policy benchmark, but let's go over the differences. Let's start with the total risk, which runs at 12.4%, almost 8% higher than the benchmark. The increase in risk was driven to a small degree by the allocation to active managers in the public equities. Some of it also driven by the ETI allocation, but the majority of the increase is actually coming from the allocation to the private markets, primarily the private equity, real estate, and to some extent infrastructure. It's also not surprising that the beta to the S&P ticks slightly higher than the strategic benchmark. We're taking slightly high level of risk in the portfolio, consistent with the objective to generate additional alpha. And related to that, you can see the third risk measure that we haven't talked so far, the active risk. Similar to the total risk measure, active risk is a forward-looking assessment of the expected returns over the benchmark. So the active risk of 2.1% means that we expect that the excess return of the portfolio over the next 12 months will be within the 2% range. Again, with a 15% probability to have higher returns and about a 15% probability to generate losses in excess of minus 2%. The majority of active risk in the portfolio is driven by the allocation to private markets, as we'll see on the next page. Meanwhile, I want to draw, not yet, sorry, we're still on this page, thank you. Just to conclude, I want to draw your attention to two charts on the right-hand side of this page. Starting with chart 1 at the top, you can see the evolution of risk measures over the past 12 months for the portfolio. You can see here time series over total risk, and you can see that the relationship between these three portfolios we just discussed has been very steady over the time. You'll notice that the overall risk levels for all three portfolios declined slightly by the end of the year and started trending higher from January. This is driven entirely by the market volatility, and therefore it's consistent between all three portfolios. A similar trend is also noticeable in chart 2 at the bottom, which shows the evolution of active risk. This risk moved up from the low of 1.7% in December, and again, is driven almost entirely by the impact of market volatility. I'll pause here if there are any questions before we move to the more detailed portfolio views. Can we have next slide, please? Thank you. So here we dive a little bit more inside the portfolio and focus at individual asset classes. We'll also try to see how the allocation contributes to the overall risk levels, to the distribution of risk, and how the risk taking translates into the performance. First, let us focus on column 1, where we show the asset class allocations and their tilts against the strategic benchmark. You can see that the portfolio is closely aligned with its benchmark at the majority of the nodes. There's small deviation from the benchmark, but mostly within the daily rebalancing range. You can see larger changes within the private assets. And notably, private equity allocation exhibits a slight overweight of about 2.5%, whereas the infrastructure and OFI are running slightly below target. Next, we'll focus on column 2, where we show the total risk at each node and the contribution to the portfolio total. The same information is shown in the chart at the bottom of the page. We can see the allocation and risk contribution for each asset class. In this chart, the blue bars represent the allocation and the orange bars represent the risk contributions. So there's several observations we can make from this chart. First of all, you may notice that equity markets make a disproportionately high contribution to the total risk level. The allocations punch among their weight are the US equity and private equity. That is not surprising, given that US stocks tend to have a relatively high volatility level compared with other regions. That is mostly because of the high concentration of technology sector in the domestic stock market, which tends to be a risky sector. You can also notice that fixed income provides a useful balance for the portfolio to compensate for the high risk levels of the equities. In particular, core fixed income and TIPS have almost negligible contribution to risk despite having a material allocation of almost 11% in the portfolio. This type of risk distribution is typical of a multi-asset portfolio and is in line with the investment process. I also want to draw your attention to column 3, which is active risk at the asset class level. Here we assess the active risk for each asset class against its own benchmark. Several observations stand out. First of all, active risk of the public market is well contained, less than 1% for both equities and fixed income. There are slightly higher levels of active risk for the developed ex-US, which is consistent with the allocation to the active managers, such as Bailey Gifford and few others. Active risk for the US public equities is a bit smaller, which reflects a larger use of passive managers. On the fixed income side, active risk runs at 0.4%, meaning that the exposures in the fixed income sleeves are closely aligned with the benchmark. Finally, we see a large level of active risk under alternatives, which is not surprising given idiosyncratic nature of this asset class and its benchmark to the public markets. So what does it mean for performance? Remember that we defined risk in terms of the ability for the portfolio to generate returns, be it positive or negative. So let's turn to column 4, where we show the 12-month returns for each asset class. The first observation is that every single node on the public markets is colored red. This reflects historically difficult markets that we've been experiencing. Both equity and fixed income markets sold off, which delivered the worst performance for the 60-40 portfolio going back almost 100 years. And the losses for some asset classes exceeded our risk forecast, especially where we rely on active managers. I'd like to point out our developed ex-US, where the losses of minus 25% significantly exceed the risk forecast of 15%. The same is true about the excess return of minus 8% for the same node, being far in excess of active risk of 3%. The fixed income market specifically went through a highly unusual period of fast run-up in rates. The first half of this year delivered the worst treasuries return since about the 18th century, and we clearly see it in the returns on the public side. The losses for the core fixed income managers significantly exceeded the risk forecast, which is not surprising given the markets. The only fixed income strategy that delivered the performance in line with its risk measure was TIPS. The alternatives, the private markets, on the other hand, delivered performance that provide a helpful diversify to public markets. Private equity and private credit returns are broadly in line with our forecasts. And the real standouts here is the stellar performance of private real estate, which exceeded our risk forecast on the positive side by a factor of 2. So I'll pause here for a second with any questions before we move to the forward-looking scenarios. Can we have next page, please? Thank you. So here we present 3 forward-looking scenarios to highlight how the portfolio may perform going forward and to highlight certain parts of our asset allocation. This quarter in particular, this exercise has been quite challenging for us, given how unusual markets are and given that the economy is still recovering from the COVID disruption. It's always a difficult exercise to pull these scenarios, but I would say our conviction level is lower than usual, and we can probably as easily forecast hundreds more scenarios. There's a high degree of uncertainty. So the base case in column 1, which we'll call softish landing. So assign a moderate conviction level to this scenario. Under this scenario, inflation pressures moderate as the supply lines and labor bottlenecks getting streamlined in the economy as the economy recovers from COVID. The Federal Reserve continues its tightening cycle, but at a slow pace, and manages to successfully address both parts of its mandate by keeping prices stable and unemployment low. Higher Fed fund rates and the positive sentiment lead to a steeper yield curve with the rates elevated versus the pre-pandemic levels. The economy is expanding, but at a slow pace, facing the headwinds of reduced productivity and global instability. The environment of higher rates, still elevated inflation, slow productivity growth, put additional pressure on corporate earnings. This leads to lower equity prices, softness in commodity prices, and a moderation of inflation. Credit spreads widen as higher borrowing costs and export headwinds present additional challenges to small and mid-sized corporations. The second scenario we'll call a negative surprise. It's more of a hard landing. And I would say as time goes by, our conviction level is growing in this particular outcome. Today's historically unique macro environment creates multiple opportunities for negative shocks and heightened volatility. This includes an energy commodity shock from the Russia-Ukraine war, which may disproportionately impact the European Union and especially Germany. The ongoing rebalancing of the Chinese economy may negatively reflect on the global markets, either through the financial sector or volatility in manufacturing. The Federal Reserve may overshoot its tightening cycle, which would push the economy into strong recession. Under this scenario, yield curve inverts further and inflation accelerates on the back of tight energy market, continuing pressure from the shelter price or tightness in labor markets. As a result, the Fed will be tightening its monetary cycle into the economy is already slowing or recessionary. The broad geopolitical environment presents additional risks of escalation, be it in Europe or in Taiwan. These or other possible shocks may lead to a significant tightening of the financial conditions by putting downward pressure on equity prices, driving interest rates higher, and widening the credit spreads. And finally, column 3, a positive surprise. I have to say it's a fairly low level of conviction, but a positive surprise may come either from a successful resolution of the Russia-Ukraine war, from a major fiscal stimulus in China or potentially European Union, or from the acceleration of the positive trends that were outlined under the base case scenario. Stronger consumer sentiment, low inflation, and a drop in rates drive most of the markets higher. Equities rally, curve steepens with the policy rate around 3%. Inflation recedes together with commodities, and credit spreads rally. The results of our forward-looking scenarios are shown at the bottom of the page. The portfolio level results are shown in chart 1 on the left. While the direction of the returns is not surprising, the magnitude of the outcome points towards some interesting observations. First of all, notice that the base scenario, gray bar, leads towards a relatively high level of loss given just a 5% decline in equities. The portfolio captures almost the full extent of the equities downside. On the other hand, the positive surprise captures only about half of equities rally. So these two scenarios happen to highlight the fact that the portfolio may be susceptible to the downside. What are the reasons and which asset classes drive the losses? Let's focus on the gray bars in the chart 2 on the right. They show the asset class breakdown on a standalone basis. You may notice that almost every single asset class experienced loss under our base case. It is not surprising that all equity investments declined by about 5%, but notice that the TIPS allocation have also experienced a loss of about minus 5%, driven by the decline in inflation. Importantly, there are no diversifiers of risk under this scenario. The negative surprise performed a bit better in the sense that the portfolio only partially captures the equity downside, therefore providing some downside protection. In particular, the TIPS allocation performed as intended, and the core fixed income losses are well contained. However, notice the outside contribution from private equity and the relatively large losses from high yield. And finally, the positive surprise scenario shown by the green bars. This scenario, unfortunately, fails to provide full capture of the upside, delivering less than 5% return while equities rally by 10%. The main reason is the loss from the TIPS and core fixed income allocations, relative underperformance of the emerging markets, and muted returns from extended credit. And also please notice that the core fixed income allocation generated losses under either of these three scenarios, which is fairly unusual. In conclusion, I just would like to highlight the limitations in our modeling approach, especially on the private side. And again, to underscore that these three scenarios represent just three possible realizations from an almost infinite spectrum of possible future states of the market. We are in historically unprecedented times, and it's very difficult to forecast the outcomes. So I'll stop here for any questions.
Okay, I think looks like I'm seeing no questions. I think that is the end of public, right, Steve?
Yeah, that's right, Allison.
Great. So if folks don't have any more questions for Steve and Ed on this, Brian, I think we are ready to go into executive session. Oh, I forgot, website. Oh my goodness. Thank you, Kate.
Yep.
Thank you, Kate. Sorry about that, folks. Okay. So in addition to the reporting, one of the things we wanted to talk, preview to you all during public session today is the new Controller's Office website that we will be rolling out publicly at the end of this month. One of the things that we have heard repeatedly from trustees that I found myself when joining the team in January was that it's very hard to find information on what our holdings are at any given moment. We get the reports and convene every month and every quarter, but they're very thick PDFs that are hard to sort through. And so, led by our Associate Director for Pensions, Kate Visconti, we've spent the last couple of months trying to redo the website to try to make the information that is already public actually accessible to trustees and to beneficiaries. So with that, I will hand it over to Kate to walk through the website.
Okay, thanks, Allison. Trustees, thanks for your time on this. I'm going to take about 5 minutes to give you a quick overview of this new tool and walk you through a few examples of how we think you might want to use it. So Allison said, as we go through this, keep in mind that all of the data presented here was already available to you in your quarterly and monthly presentations and in the PDFs on the website, but it wasn't incredibly user-friendly, so this tool attempts to solve that.
So sorry, sorry, Kate, I don't know if I'm not seeing your screen. I just see like a thought bubble that says you're trying to share your screen. I don't know if anybody else is having that issue or if that's just me.
I was seeing her screen.
Oh, you were?
Yeah,
okay,
we
then it's my computer. Keep going. I've seen this before. So.
Okay, well, it might be fixed now. Otherwise, if other folks can see it, I'm going to go ahead. So, okay. So over here now you're seeing the tool. So this is right now all of the assets under management for all of the 5 systems. So let's go ahead and select NYCERS and BERS over here so that we can look at just your 2. So you can go ahead and do that by clicking anywhere that you see those. You can also do it up here. These are filters. So now you're looking at the tool specifically for NYCERS and BERS. Up here in the top left, you're seeing the total net asset value for your 2 systems. You're seeing down here it broken down in this bar chart form. Over here on the right, you're seeing that same information, but now broken down asset class by asset class. So for example, private equity, you're seeing 900 million, the unit is million here for BERS, and about 8 billion for private equity for NYCERS. Down here on the bottom left, you're seeing that same information displayed visually. And then over here on the bottom right, you're seeing what we expect to maybe be the most useful new addition with this tool. This shows you all of your investments with their investment name and some corresponding information over here and their corresponding net asset value. So to show you one example of how this might be useful, let's say you're interested to know all of the investments that you have in private equity. So you could go up here to asset class and select private equity. And now you're looking at the same tool filtered for your 2 systems and for private equity. So a total of 8.9 billion across the 2 systems in private equity. And then down here, you're seeing all of your private equity investments and their net asset value. So for example, scrolling down here, you see EQT Fund 8 for BERS has about 17 million in net asset value currently. So let's say you're interested to understand more about your EQT investments, but you know that there's money across private equity and other asset classes. You could get rid of this filter here, come over here and type EQT. And as you select these EQT investments over here, you see the tool populate with all of your EQT investments. So you can see over here you have 767 million with EQT across your 2 systems and across asset classes. You can see here the breakdown between infrastructure and private equity. Down here on the bottom left, you see that displayed visually, so you can tell right away it's about 1/3 in infrastructure, 2/3 in private equity. And then over here on the bottom right, you can see all of the detail, including the net asset value for each of the different investments. So let's say maybe it was a member who was asking for all of the information around your EQT investments for whatever reason, and you wanted to export this and send it to them. You could just click on the 3 dots on any of these sections, click export data, and then you can download it. It'll come to you as an Excel file. So this is the net asset value, total AUM sort of side of the tool. We now have another tab for asset performance specifically. So over here on the top left, you're seeing the performance fiscal year to date across the 5 systems. So you can select a month, let's say April 22, and you'll see fiscal year to date performance by system. Over here on the right and down below, you're looking at system performance across years by asset class. So right now the asset class selected is overall, so you're seeing the entire portfolio, and you're seeing that down here as well over these different years. You can select, for example, here infrastructure, and all of it will update. Now you're seeing system by system, year by year performance, specifically in infrastructure. And then you're seeing that again displayed visually down below. So trustees, that's my sort of whirlwind overview. We hope this is going to be helpful to you. We wanted to give you early eyes on it, hear any feedback you have. We recognize this is your data, so your thoughts and sort of improvements are important. So any questions?
Brian Berge from the Mayor's Office of Pensions and Investments. I was curious when this is going to go live. It seems extremely useful.
Yeah, good. It's going to go live, so we're sort of touring it around all of the systems. We'll have the last one likely this week, and then I don't know that if there's really going to be any further delay after that, unless any trustees have any feedback that we need to implement. I think it should go live fairly soon after that. Allison, is that right?
Yeah, I would say around on or about October 1st, once we get to the, I think fire is the last board meeting at the end of the month.
Any other feedback or?
This is Kate Santander
Yep.
here from NYCERS. Just want to thank you and your staff. It looks like a tremendous amount of work, and I'm sure will be very useful to us. Thank you again. This is something unprecedented. So thanks again. We look forward to it.
Sure. Yeah. It's been useful for us already too. Glad you.
Great. Okay. I think with that, we are ready to go into executive session, Brian.
Sure. May I have a motion to enter executive session?
So moved.
Second.
Thank you. Any discussion? All right, all in favor, please say aye.
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 Opposed, please say nay. Any abstentions? And the motion carries.
Funds into infrastructure investments and also took action on an alternative credit investment, including agreeing to invest funds. The details of these transactions will be released at a later date.
Motion to adjourn.
Second.
All right, and all in favor of that motion?
Aye.
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 All opposed? Any abstentions? Hearing none, the motion carries.